Hello YouTubers, welcome back to the Independent Investor weekend update for November the 18th. Just going to talk a bit about, a little bit more about junk bonds. I mentioned that last week. Again, ETFs a little bit, and just a few trades I did last week. I really didn't do too many. I did a few option trades, but just kind of, I continue to keep my cash levels fairly high. I'm about 40 to almost 50% cash, the highest I've been since the beginning of this bull market that really started back in 2009. Last week again, for 2 weeks now, the markets have been down, and except for Thursday, which was a strong day and a bit of a recovery day. That was mainly because of Walmart. Walmart came out with pretty good earnings, and also on Thursday, the House of Representatives passed a bill that would reduce corporate tax rates to its lowest point since 1939, and cut individual taxes for most households. So that was good for the market overall. Lower taxes means higher income for companies, which again supports stocks. But I still think this tax breaks is still tilted more towards high income people, and it doesn't really help the middle class that much. I think the corporate tax rate in the United States is too high. It's one of the highest around the world, and that's why a lot of these big multinational American companies leave a lot of their money that's made overseas there and don't bring it back into the United States. So this might help with the lower tax rate and would be good for the American economy. But I still don't, it's really the middle class that, they're the consumers. I mean, the economy's, I think, driven 75% by consumer consumption. So if you don't have a middle class, it's really hard, to have a real strong economy. That being said, there was some not bad economic data. I think industrial production numbers were pretty good last week. Increased 0.3%, and but again, we're still seeing, which I focused really on last week, is the junk bonds. So as I've said, junk bonds and stocks kind of trade together, and one can forecast a change in the other. So if we saw a continued breakdown in junk bonds, we could also then expect maybe the share price or the equity markets to drop. And so last week, and one of the sectors that's taken on a lot of debt is telecommunications, Forward Communications, CenturyLink. These companies have been doing large acquisitions or mergers, which typically leads to a lot of issues in debt. And with all the changes right now in that whole area and competitiveness, it's questionable if they can get the cash flow returns to pay for this debt. And I've also said the whole fracking industry in the United States is based again a lot on debt issuance, and we're seeing, as I mentioned last week, oil prices kind of come up, but then last week they started to kind of come back down. So we really seem to be stuck in this $50, $60 trading range with oil, and I don't really know if they can get out of that, because as the price comes up, the frackers start to produce more, even though OPEC might bring their production down. So there's always this kind of offsetting nature. Yeah, so right here, this is the telecom companies make up almost 10% of the high yield benchmark of one of the big funds. And price of debt issued by these companies jumped last week to 6.6%, so up from 5.4% a month earlier. So that 1.2% in 1 month is quite significant. I have taken a short position, buying long puts in CRR.UN-T, which is a junk bond ETF, which I mentioned last week. It actually corrected quite a bit, and then it came back up, and my long puts have come up a little bit in value, but not too much. But it's early days on this, but it seems to be getting a little bit more global too. Even around the world now, we're seeing emerging market debt, harder for companies to actually issue debt. The investors are asking for a higher return to offset the perceived risk. So here's another one here. Oil and gas, Resolute Energy, which failed to attract enough interest in refinancing efforts that would have replaced its 8.5% notes 2020 with long maturity, low coupon bonds. So they weren't able to raise funds to pay that debt off. So, and I talked a little bit about the flattening of the yield curve last week, and if the yield curve inverts, that's a very good sign of a possible recession. It's had a very accurate forecast in that. And now we see that it almost looks like the treasuries are, Treasury Department's kind of managing their debt to try shift that a little bit. So they're saying the total issued debt will rise in coming years with growing federal deficits, and supply increases likely to weigh on bond prices pushing up, which prices down. And